What we're going to start with here is an overview of everything that's happened in the S&P 500 over the current calendar year. These are all the dips, valleys, peaks, all combined into one chart, the daily chart. And from this, we're going to gather a couple key points to look at for trading on the hard right edge. These are points that every trader should have marked on their chart. The first and most important one you have to do only once a year for your chart is the previous year's close. This is relevant for a number of reasons, but simply the only reason it needs to be relevant is the fact that people pay attention to this number. So we're going to find out what that is. So right here, we have last year's close, 12th month going into the first month of the first day of 2015. All we're going to do is take our drawing tools and put on a horizontal line right where it closed. So the day closed down right here. We're going to increase that size a little bit and give it a nice blue-violet color, so we'll really know when we're running into it later on in the year. That's our first really important line. And as you can see, the market bounced off of it multiple times throughout the year. So this would have been a very important line to have up on our charts earlier on. Right now, as you can see on the hard right edge, we're quite a ways away from it. So right now it doesn't hold too much importance to us until the market either comes back up there or possibly starts going to new lows. That's where we're going to put our next line. We're going to put it at the year's all-time low. This line is actually a little bit more relevant to us right now because we're closer to the year's low than we are to the previous year's close. One of the reasons the previous year's close is important is because a lot of large fund managers simply go long on the ES. They take a long bet that the ES will go up year on year, and that's how they base their performance. A lot of companies will also base their performance completely against that. So if the ES is down 100 points, all they're basing their yearly on year performance against is the fact that they're trying to do better than down 100 points on the ES. The year low is always another important line, and that's why we've marked it off. It signifies the absolute lowest value that the S&P 500 had. That is the most anyone was ever willing to sell for, and at that point, the buyers came in and thought the ES was a fantastic bargain. We're going to also increase the size of this line. The next line that we're going to bring up is the year's high. This line also has a lot of significance because it's the most anyone was willing to pay all year for the S&P 500. We're going to increase the size of this line as well. Although in this trading course, I don't believe that the market is probably going to make it all the way down or all the way up to one of these lines, they still should be on your chart all year round, as long as they remain relevant. When the ES makes a new high, make sure you mark that off and change the upper line. If it makes a new low, make sure you mark that off and move your lower line. If the market spends a lot of time bouncing in and around the previous year's close, you can end up getting rid of that line because it obviously isn't holding any relevance at this point during the year. We're into September right now, so it has held a lot of significance for the last 9 months, but we may find that over October, November, and December, the market ends up trading a lot within this level, and that we no longer want to consider it a point of significance. It's one of those free-floating areas that we may want to pay attention to as long as it remains relevant. Next, we're going to drill down into the 60-minute charts to see what is actually happening in the market right now and what we're going to base our upcoming trades on the hard right edge on.